Let's talk about banks today, where most of all our money is kept. What is the role of banks in our life? We are told that banks take deposits and lend out loans, and they make money out of that. Is their business model? Well, it's true, but it's not the full story. Banks play a much bigger role in our lives than just handling deposits and loans. Here's the shocking truth: their main job in society is to create money out of thin air. You heard it right, out of thin air. It sounds incredible and crazy that banks manufacture money out of nothing. This is precisely what an old banking theory tells us, a theory that has been brushed under the carpet for almost 100 years now. Let us dig deep into this mysterious role of banks that no one talks about. Thanks for tuning in. This is Nadeem. You're watching Empire Diaries. Let's first understand where all our money comes from. Most people think that the money we have is produced by governments and central banks. That's not entirely true. Only about 3 to 5% of the money supply in most countries comes from governments and central banks. It comes in the form of currency notes and coins. That leaves us with the remaining 95 to 97% of the money supply. Where does that come from? Who produces all that money? The answer is high street banks. Private banks and government owned banks in your locality and all over society create 95 to 97% of the money from scratch. It is produced in the form of electronic money. Now, what is electronic money? It's the money in your bank accounts. It exists in the computer systems of banks. Let's understand how this money creation out of nowhere happens with a real world example. What happens when you take a loan from a bank? The bank makes it look like they're transferring existing money from their accounts to you, right? But technically speaking, that doesn't happen. The bank doesn't lend you any existing money. Instead, it creates new money. Then it opens an account in your name and it tells you that your approved loan can be accessed from your newly opened account with the bank. And you are free to use that money. So the bank isn't actually transferring to you any existing money from its own accounts. Instead, your decision to take a loan resulted in the creation of new money, which the bank handed over to you. Of course, the bank hasn't given you the newly created money for free. In return, it has purchased a security from you. In strictly legal terms, banks are in the business of purchasing securities. That's it. Now, let's look at the process more closely because it is important to understand that banks are very special organizations since they have full permission to quietly manufacture most of the money that society needs. So, when the bank approves your loan, you issue a promissory note or a security in writing, which the bank purchases from you. In return for what? For giving you access to the new money it has instantly created for you. That's the whole transaction. And how does the bank create the new money? A bank official creates it in electronic form simply by clicking a few buttons on a computer keyboard. That's it. This absolutely insane but sensible observation about banking is made by a school of economic thought called the credit creation theory. The theory has been floating around informally throughout 5,000 years of banking history, but it came into the limelight only in the late 19th century. By then, it was openly discussed and accepted in banking and economic circles in Western Europe. But during the 1930s, the credit creation theory was sidelined and a different banking theory was floated. That is called the fractional reserve theory. Then in the 1960s, this theory was phased out and replaced by yet another one, which is called the financial intermediation theory. Right now, this financial intermediation theory is the most widely accepted banking theory. Let's quickly look at the two recent theories that replace the older credit creation theory, which says banks create money out of nothing. The fractional reserve theory says banks don't create new money. Instead, banks individually act as only financial intermediaries. That is, they make a living by taking deposits and lending out loans. But all the banks collectively play the role of creating new money in society through what is called the money multiplier process. Friedrich Hayek and Joseph Stiglitz are two influential economists who supported this theory. The latest school of thought, called the financial intermediation theory, further plays down the role of banks as money creators. This theory says banks are just financial intermediaries. They only deal with deposits and loans. Neither individually nor collectively do they add to the money supply in society, let alone creating money out of thin air. Top economists who supported this theory are Raghuram Rajan, Anil Kashyap, John Maynard Keynes, Ben Bernanke, and Paul Krugman. Now, coming back to the older credit creation theory, well known economists who supported it include Irving Fisher, Henry McLeod, Joseph Schumpeter, and most recently, Richard Warner. German economist Richard Warner famously invented the monetary policy that we now know as quantitative easing back in 1994. Today, Warner is a firm believer that banks produce money out of thin air. His support for the 100-year-old credit creation theory is based on a successful experiment he ran a few years ago. He presented his case in a detailed report following an investigative empirical study of a loan transaction that he carried out at a real bank. His landmark paper concluded that whenever banks issue loans, they manufacture new money out of nothing. His paper was published in 2015 in the popular finance journal International Review of Financial Analysis. The paper is titled A Lost Century in Economics: Three Theories of Banking and the Conclusive Evidence. So we can say that all high street banks are tasked by some higher authority to create money out of thin air and release it in the economy as loans to individuals and organizations. It's an enormously powerful role, isn't it? That your next door bank can decide how much money it will create and release into the economy. Now, the question is, why does it happen in hush hush tones? Why is the credit creation theory, which wonderfully explains this role of banks, downplayed in mainstream discussions? In other words, if banks create 95 to 97% of the money supply, why is there an attempt to hide it? We are openly told that the government mints coins and the central bank prints paper currency. But that's just 3 to 5% of the money supply, as we discussed earlier. We are never openly told that the normal banks manufacture the main chunk of the money supply, just like that. Why do most influential economists avoid bringing it up? Why is the credit creation theory downplayed even in textbooks? We will return with the answers to these haunting questions in our next episode of Declassified. Thanks for watching. Subscribe to our YouTube channel. Don't forget to press the bell icon so that you get notified whenever we publish a report. Follow us on Twitter and Facebook. Send get updates to 98210457339 for news and analysis you are not told. Visit our website empirediaries.com for in-depth reports and columns. Stay informed, stay awake, and think critically.